In part two of our discussion, we're going to be talking about miners. So now you mentioned that gold on a fundamental basis is one of the most undervalued assets. What about the mining stocks now, Michael? What's your thesis there?
Yeah, there's some great news. So you look, the gold industry's done an amazing job cleaning itself up. They got a bit over their skis excessive from 2008 to 2012 in the last bull market. They
Yes.
lost control of costs. They put on way too much debt, did a bunch of bad acquisitions. It was growth over returns for the industry for a large majority of that time. From 2012, after the blow up to the current day, they've been cutting costs, focused on returns, returning capital to shareholders. I got a few slides we want to show today, I think, on free cash flow yield. The free cash flow yield of the gold sector, if you look at a 40-year chart, I think 1970s to today, there's never been a time where the free cash flow yield of the gold sector has been higher. For most of that 40-year period, as you can see by that chart, it's significantly negative. Over the last 3 or 4 years, you see those green bars spiking up. Significant free cash flow yields and significant free cash flow growth. That's because they've cut costs, focused on returns, stopped doing bad acquisitions, and are now generating lots of free cash flow and paying significant dividends to their shareholders. So that's the first point. The industry's never been better fundamentally at a time where the least amount of investors probably ever have interest in the sector. Second point I make is the free cash flow yields on an absolute basis are quite attractive to show that slide there. But on a relative basis to the rest of the market, the next slide you're going to show, I think, is free cash flow yield of the gold sector versus the other sectors in the market, minus the inflation rate. So you look at this slide, the gold sector, precious metal sector, is the only sector in the market that has a free cash flow yield higher than the rate of inflation. So every other industry is generating less free cash flow than the rate of inflation every year, generating negative real free cash flow yields. The gold sector has the best free cash flow metrics across the board in the industry, in the market right now. Yet again, the sector is trading at depressed valuations and nobody wants to own it. So to me, as a contrarian investor, as someone who wants to protect my wealth and make a lot of money if I'm right, this risk reward looks fantastic to me versus the other sectors that are extremely highly valued and vulnerable to a lot of these inputs that we're seeing inflationary, going to cause significant damage to their earning streams.
Okay, but going back to the first part of our conversation, if you think that equities are due for correction, wouldn't that pull the gold miners down with them?
It will pull them down, but a lot less. If you look at where the GDXJ is today, it's a junior miner producer index. I looked at it, it's 15 or 20% below where it was in 2016. Gold was trading at $1,300 an ounce in 2016. Today, gold is, I think, $1,775 today, and it's down 20% from where gold was when it was at $1,300 an ounce. So how much lower can that go? Again, in a correction, everything goes down. To me, that's temporary. What happens after the correction and once the market resets itself? I don't see a lot of downside in the gold equities that are pricing in gold, below $1,300 an ounce today, versus the market is pricing in 0% interest rates and nirvana forever in terms of fundamental positives going forward in the market.
Okay. Are there specific miners that you like right now? Well, do you like the juniors first of all versus the seniors, or vice versa?
Yeah, I think, in my line of strategic investing, I've focused very much on the exploration sector in general. So I've been quite active. If your investors follow my activity, I've done 3 large placements in the last 3 months. I like to buy when the market gets a bit squishy. So gold market's been soft, so you get much better opportunities. I made a big investment in a company called Big Ridge Gold, BRAW. Made a recent investment in American Pacific Mining, USGD. And I announced one 2 days ago, Constantine Metals, CEM. But I own about 20 to 25 junior exploration companies in my portfolio. I do think that the producers are quite attractive here, like GDXJ or GDX, the producers, because of that free cash flow yield that they're generating. I talked about with you earlier, because of the depressed valuations and because of the upside that I see in gold. I think your more conservative investors would definitely want to look at some mid-tier producers, and the ETFs are a great way to play them. GDXJ or GDX, take a look at those too. They're down well off the highs. Fundamentals are fantastic. Good liquidity in those ETFs, and you get a good basket of producers that are paying dividends, free cash flow generating companies that are deeply undervalued, in my opinion.
Okay. I was speaking to Bear Gold, and one of their plans going forward is to do more of the exploration in-house rather than buy up the juniors. Now, their strategy is a little bit different from some other seniors, and so I wouldn't characterize the entire senior mining subsector as having the same strategy. But nonetheless, do you think M&A is in sort of a lull period right now?
No, I think M&A has been affected by COVID. I think you're going to see a huge resurgence in M&A. I mean, I've been fortunate. I had 3 or 4 producers in my portfolio that got taken out in the last year. So it's been relatively active. You've seen quite a few deals. GT Gold got taken out. Battle North Gold got taken out. Rocks Gold got taken out. So you've seen some M&A activity. I think one of the big impediments to more M&A, David, has been the COVID situation. So to do proper M&A due diligence, you want to go do site visits, and many of the sites have been inaccessible due to COVID, unable to get people on the ground to do proper due diligence. I do see a huge upturn in M&A. I think Barrick may be unique. I still think Barrick's going to be active on the M&A front because these companies are depleting their reserves and production every single year. There's been 10 years of underinvestment in the exploration sector. So the pipeline for these large companies is effectively bare, and they're generating huge free cash flow. And so I think you're going to see acquisitions of, really good projects that have potential to become mines in this cycle start to dramatically accelerate in the back half of this year into next year. I think that's definitely going to happen, and these miners will be more careful than they were in 2008 to 2012. You're going to see less of these mega mergers, bigger is better type deals, but I think you'll see a lot of strategic acquisitions of top quality exploration companies with great assets and single asset producers that have assets that the majors are coveting and wanting to have in their portfolio.
Okay, excellent. All right, thank you very much for your thoughts today, Michael. Great update.
My pleasure, David. Always a lot of fun to be with you. Thanks a lot.
I'll speak to you again next time. And thank you for watching Kitco News. I'm David Lin. Don't forget to subscribe to our YouTube channel and follow me on Twitter at DavidLin_TV.